Hey everyone, and welcome. Today, we're going to talk about something that most of us deal with, but maybe don't really truly understand loans. I mean, from buying a house to funding a wedding, there's a whole secret story behind those numbers. So let's peel back the curtain. Seriously, have you ever stopped to think about it? You see that EMI pop out of your bank account every single month, but where does that number actually come from? It's not like the bank just picks it out of a hat, right? Nope. There's a whole system, a bit of history, and some real logic behind it. And that's exactly what we're going to break down today. All right. So to really get a handle on this, let's step into what I like to call the loan verse. Because let's be real, loans aren't just boring financial documents. They're the actual tools people use to build their lives and make big things happen. So let's meet a few people whose situations might sound pretty familiar. First up, we've got Ria. She's at that huge, exciting point in life, ready to buy her very first home. And like millions of us, she's looking at a 40 lakh rupee home loan to turn that dream into an actual address. Then there's Amit. He's got a big family wedding coming up. You know how that is. A massive celebration. He needs about 2 lakh rupees to help cover the costs. And for that kind of short-term goal, a personal loan makes perfect sense. And finally, let's meet Mahul. He's got his heart set on a new Breeza. He's going to get a car loan to make it happen, spreading those payments out over a few years. So, you see, 3 different people, 3 completely different dreams, all powered by the same thing, a loan. Okay, now here's where it gets really interesting. The interest rate that Ria, Amit, and Mahul will pay today is dramatically different from what they would have paid 20 or even 15 years ago. And that's all thanks to what I call the interest rate revolution, a quiet but incredibly important fight by the RBI to make the system fair for all of us. Because, the old system was, well, it was a mess. Just imagine this. You and your friend walk into the same bank on the same day for the exact same loan, and you walk out with totally different interest rates. How was that even possible? It was confusing, it was hidden, and frankly, it just wasn't fair. So the RBI knew it had to step in and fix this. It's been a journey, starting way back in 2003 with that messy BPLR system. By 2010, we got the base rate, which was a step in the right direction. 2016 brought the MCLR system, which was even faster. But the real game changer, the big one, landed in 2019, when they finally linked our loan rates directly to the RBI's own repo rate. That was a total revolution in transparency. So what does all this mean for you today? It means your interest rate is no longer some big corporate secret. It's actually a pretty simple formula. You start with the repo rate, which the RBI sets for the whole country. Then the bank just adds its spread. That's their margin for their costs and their risk. And boom, that's your final interest rate. Clean, simple, and tied directly to the economy. Okay, so that spread the bank adds on. You might be wondering, how do they decide what that is? Well, a massive factor is just one word: risk. And the number one way that banks manage their risk is by asking for something called collateral. It's that age-old question, what can you offer as a guarantee? And what exactly is collateral? It's really straightforward. It's just an asset, like your house, your car, maybe even some stocks, that you pledge to the bank. It's your promise that says, hey, if for some reason I can't pay you back in cash, you can take this asset instead. And this one idea splits the loan world into 2 giant families, secured and unsecured. A secured loan, like Ria's home loan, requires collateral. In her case, the house itself. For the bank, this is really low risk, so they give her a lower interest rate. But an unsecured loan, like Amit's personal loan, has no collateral. That's much higher risk for the bank, right? So they charge a higher interest rate to compensate. It's a direct trade-off. More security for them means a lower cost for you. But loans aren't always just about risk and rates. They can also be these incredible, powerful tools for changing lives. There are some really special loans out there that are designed not just for making a profit, but for serving a purpose. Take a look at this number, 4%. I mean, in a world where we're hearing about interest rates of 8, 9, maybe 12%, 4% seems almost impossible. But I promise you, this rate is real, and it's for a very special kind of loan. This is the interest rate for something called the Differential Rate of Interest, or DRI scheme. It's designed specifically for the poorest of the poor. It's for people like Ram, a farmer in Bihar who couldn't afford seeds. A tiny loan of just 15,000 rupees at this incredible rate was enough for him to buy what he needed, grow a crop, and literally build a sustainable living for his family. It's finance with a conscience. Now, let's look at another totally unique problem. I want you to meet Shanti Devi. She's 68, she's retired, so she doesn't have a monthly income. But what she does have is one incredibly valuable asset. And that asset is her home, which is fully paid off and worth 60 lakh rupees. She's in that classic situation of being asset rich, but cash poor. So the big question is, how can she use the value that's locked up inside her house to live comfortably? Well, the answer is a fascinating product called a reverse mortgage. In simple terms, the bank basically starts paying her a salary against the value of her house. In her case, she receives 30,000 rupees every single month. This lets her live with dignity and financial security. And get this, without ever having to make a single EMI payment herself. Okay, so from these really amazing, life-changing loans, let's pivot to a financial tool that many of us use every single day, often without even realizing the powerful system working behind the scenes. Let's meet Rohan. He's a small business owner, and the bank gave him a working capital limit of 5 lakh rupees. This is called revolving credit. Now, last month, he only needed 2 lakhs. So here's the crucial part. He only pays interest on the 2 lakh he actually used, not the full 5 lakh limit. He can borrow, repay, and borrow again, as much as he needs, as long as he stays within his limit. Does that sound familiar at all? It absolutely should, because this is the exact same principle that powers your credit card. You have a total limit, but you only pay interest on the amount you've spent and haven't paid back by the due date. It's a flexible, powerful form of credit that's pretty much all around us. So let's bring this all together. What's the main takeaway here? Well, thanks to this whole revolution in the system, your loan is no longer a mystery box. It's more transparent, and it's directly tied to the economy. You now understand the trade-off between giving security and getting a lower rate. Basically, you're not in the dark anymore. And that brings us to the final, and I think most important question. This isn't just theory. This is practical knowledge. Understanding the system, knowing how rates are set, that gives you power. So the real question I want to leave you with is this. Now that you know the rules of the game, how are you going to play it differently?